principals at, I was just interrupted. Let's start again. Good afternoon, everyone. I'm Kathy Neifeld, one of the principals at Agency One. On behalf of my partners and our amazing Agency One team, I am thrilled to welcome you to our bi-weekly webinar series. This is the 12th webinar we have hosted this year, and all of the webinars, with the exception of one, have been recorded and can be found on either the Agency One website or on our YouTube channel. If you are looking for information on estate protection, on asset protection and estate income and gift tax planning under President Biden's administration, digital marketing tools, strategies, and resources that you should be using to help drive more business, a premium financing update, underwriting information, a current economic update, information on whole life carriers and opportunities in the whole life marketplace, information on Proformex and in-force policy monitoring system, or information on product changes, price increases, and specific conversion opportunities from various carriers, or perhaps are interested in an industry perspective from the president and CEO of John Hancock Life Insurance Company, I encourage you to access these webinars. The speakers are nationally recognized and renowned industry experts, including estate planning attorney Alan Brown, advanced markets consultant Randy Zipsey, digital marketing expert Samantha Russell, the Senior Vice President and National Director for Premium Financing at U.S. Bank, Taylor Miller, economist Anirban Basu, Brooks Tingle, the President and CEO of John Hancock Life Insurance Company, our very own superstar underwriting team led by my partner Dennis Bartos, or our very own head of case design and illustrations, Ed Stark, and there are even more. So please be sure to tune into those webinar recordings. For those of you that are new to Agency One, a brief introduction. We are a very high-touch, exclusive BGA. Exclusive, what does that mean? We have a platform called the Agency One 100, and one of our guiding principles is to work with a small, select group of advisors in a very large way. The advisors that are part of this group are like-minded, highly successful, creative, and driven. We focus on life insurance and fixed annuities. If you have other needs, like disability insurance or life settlements or standalone long-term care insurance, we have strategic relationships with the best providers in the industry to refer you to. We truly have the premier underwriting department in the industry, led by my partner Dennis Bartos, and advanced markets and case design departments led by my partner Gonzalo Garcia. If you want high touch, personalized attention, advocacy, and want to feel like you and your cases are important, then Agency One is or should be your BGA. If you would like to learn more about us, the Agency One 100 platform, and how you can become a part of it, or if you have a case you would like to discuss, please reach out to us. I have some important additional announcements about what Agency One has planned for the next few weeks, and I will be sharing them with you at the end of the webinar. Now on to today's webinar, Life Insurance Strategies to Capitalize on Opportunities in the Small Business Marketplace. Please get out a pencil and paper and start to write down all of the small businesses you have either done business with in the past or are currently prospecting. These businesses are facing risks daily due to the loss of a key employee, death of an owner, increases in the value of the business, or unfunded or underfunded buy-sell obligations, and more. I am thrilled to introduce our speaker for today, Brett Berg, Vice President of Advanced Planning for Prudential, who is going to address all of these issues and more. Brett has more than 20 years experience in estate planning and advanced marketing. Brett will try to respond to any questions that have been asked at the end of the presentation, so please submit your questions through the question or chat feature at the bottom of your screen, and we will be monitoring them as they are submitted. This session is being recorded. I now turn this session over to Brett. Brett, take it away.
Well, thank you. And my thanks to Gonzalo Agency One and all of his team for having Prudential today as a guest and having me. It's a great pleasure to address you today. We are going to talk about small business and the small business ebook and really go through a lot of the materials that we have. And I think that it's important to do that in a context in which we're operating, the environment in which we're operating, and really not lose the lead story. Okay, the lead story is that there is intense pressure, there is intense attention to taxes, right, in our country. And what we have is a situation where businesses are operating within that. They're coming out of COVID. They're recovering. So what are the various opportunities that we have? We really have to focus, as really the lead in from Agency One said, we have to focus on risks that lead to needs that lead to opportunities. And I think that really I want to focus on those themes today and how Prudential's materials and how our expertise and our content fit into that. I will weave into the conversation, but also I don't want to lose the current events and what's happening. So I really want to level set us all on, yes, the lead story from a political standpoint may be taxes. I think the lead story from a planning standpoint needs to be how we serve the needs of these small business owners and the small businesses with tax diversification, which life insurance obviously contributes to. Planning for the flexibility that they need to encounter any tax environment and really grow within that context. Because when we think about a small business, and now let's get into a little bit of our way of contextualizing this in terms of what the opportunity is, and then looking at the stages of a business and what the various opportunities are relative to the risks and the needs that are within that business. What we need to do is say, okay, what are we looking at in terms of an opportunity? And what we see in terms of the statistics that are there on the slide are the number of small businesses within the US, according to our statistics. You can read whatever statistics you want, but it's a very high number, right? It depends on how you define small businesses, right? I've seen other statistics that say 99.7% of businesses in the United States under 500 employees are small businesses. So it depends on how you define it. There's a huge opportunity here in terms of how to serve them depending upon the stage that they're in. And I think that that's really what's important to remember about this presentation, is that I'm going to take you through the stages of development. I'm going to focus perhaps more on this transition stage and the mature stage of the businesses, because it lends itself to life insurance planning opportunities such as buy, sell, and other opportunities that we talk about traditionally. But I also want to weave in some points about the earlier stages of a business and how to help them really contextualize their need for life insurance to offset the risks that they have, and also take advantage of the opportunities that they have to contribute to the stability of their business and grow their business in a very, very meaningful way. So with that, we've really developed this ebook as an interactive ebook. And after this conversation is over, you're going to get a copy of this ebook. It's very interactive. It links to all of the materials depending upon the stage of the business that you're dealing with, what they may be interested in, and what materials map directly to that opportunity. And these are just our materials. You have all of the resources of Agency One at your disposal, not only our company, but all the companies that Agency One represents. So even though I'm here as a representative of Prudential, want to promote Prudential, what I really want to do is say, in partnership with Agency One, I want to promote the joint resources at your disposal to develop these cases, to execute on these cases, and to really help your clients make their lives better, given all of the resources that Agency One brings to you with its absolute commitment to the high touch and high tech and really a comprehensive way of dealing with cases that you heard at the beginning of this session. So let's talk about the startup stage. Businesses are born, they grow, they mature, and then they transition, much like people do, right? So this is the startup phase where we have a startup opportunity with a person who's a go-getter. It could be a tech firm, could be an investment firm, could be any firm, right? And when we see the opportunity here, it's to really help this person find funding, right? Credit is very important. Loans are very important. What's a current event that I weave in here? The low cost of credit, the low interest rate environment. This should be, as we come out of COVID now, a very robust time for startups. What's the life insurance opportunity? Well, a lot of you may say, well, Brett, I think that there's a life insurance opportunity for the owner. Absolutely there is. That's more of a personal planning type of opportunity, sure. But also on the business side, there's a key person opportunity just for the owner. The owner should take into account not only the personal needs that owner has if something happens to him or her, but also what happens to the business. Very fundamental. And I know a lot of you are very experienced in the business, and you're going to say, well, that's just elementary, Brett. It is, but it's missed. It's missed often. And I don't want to leave any opportunity on the table. And I think this is one of the biggest risks that they face. In addition to that, I talked about the low cost of credit, the low interest environment right now, an ultra low interest rate environment that we're in, not only helps us from a personal planning perspective, but also from a business perspective. But what does that create? It creates debt. Whenever we have debt, we have the obligation to repay that debt. What happens if the business owner or key people die early, something bad happens, something unexpected, like a pandemic happens, and takes these people out of their jobs permanently in terms of a premature death? What happens then? How does that loan get repaid? What are we going to do to identify who should be insured for what amount to ensure not only the continuation of the business in the absence of a key employee, but also the repayment of the debt that was created to start this business up. Now, I'm going to also mention something here that I'm going to dive into a little bit more as we grow the business, but I also want to touch upon it here as we start up the business. One of the things that I'm going to talk about is benefit planning. And many of you may say, why in the world is Brett talking about benefit planning in a startup? They're starved for cash. They need to, have a lot of credit, what have you. Sometimes we don't talk about recruiting, retaining, and rewarding key employees until we really start to grow the business. But I think I want to really start the conversation in the startup stage for a very key reason that was brought to my attention this morning in a paper that we just came out with at Prudential called The 4 Predictions, How the Events of 2020, 2021 Will Impact American Households and Employment. And I'm going to make sure that Agency One has a copy of this white paper, and you'll all have a possession of this white paper as well as this presentation. But here's the key insight that I was reading just before we came on air. And I thought, I'm going to weave this into the startup phase because I think that in the startup phase and even in the growth phase, this is very, very important. But the observation that was made, there were 4 key trends, and I'll just give you the 4 trends, okay, to give you context. Greater emphasis on closing financial security gaps. I think we can see how insurance would fit there, and we may talk more about that later. Number 2, though, is the one that I was focused on. Borderless employers transform how companies recruit, retain, manage, and motivate employees. Here was the takeaway. As we get into location agnostic work, right? Working remote, working wherever we find ourselves, and companies recruiting our clients to work for them. What may happen, according to this study, is that wages may not be paid as much as they were in the past, because I'm not required to move to New York or Los Angeles. I can work in Idaho, for example. Companies may not offer me as many wages or as much in terms of wages, but what they will need to do is provide a robust benefit package. That was the language from the paper that I'm really seizing upon. And as a person who really grew up in non-qualified executive benefit planning, that's where I first met Gonzalo many, many years ago. When I was doing non-qualified executive benefit planning, I started thinking to myself, even in the startup stage, it's probably going to be important. Even as these companies reach out and try to get talent, yes, they're going to have to pay wages. Maybe, not as much in terms of wages as if they would move that person to New York, Los Angeles, Dallas, Atlanta, something like that. But they're going to have to think about the packages that they're offering. And part of that package can be life insurance, everybody. It's real simple. It's an executive bonus for a policy that's owned by the executive. It may be split dollar. That will become very important as we talk about the tax developments a little bit later on. And maybe we'll just do that right now. Let's talk about the tax developments. What do we have in terms of tax developments? We see that corporate rates are likely going to rise if the package that has been proposed by the president is adopted, right? We don't know to what, 21% to 28% to 25%, what have you. But the real salient point I want to make about benefit planning is that when we think about what we're going to offer an employee. Let's say we have an employee and that employee is in Idaho, and I'm going to pay wages that I would not ordinarily pay in New York, but I'm going to pay them in Idaho. They're going to be competitive. But in addition to that, I'm going to say, in addition to the competitive wages for Idaho, I'm also going to offer you an executive bonus plan. Well, that would be more compensation, so it might push the bracket up. Well, what about split dollar, right? Because the corporate rate is likely still to be lower than the individual rate. Individual rates are set to go up to what? 39.6% under the president's plan. Whenever the corporate rate is lower than the individual rate from a benefit planning perspective, and if I'm going to talk about providing a life insurance benefit for that employee's family, in addition to all of the other benefits that I would provide, a 401k perhaps, or another qualified plan, a robust package of perhaps leave, perhaps, obviously remote work, all of the things that I'm providing. I'm also going to provide life insurance coverage for that person. How am I going to do it? Probably through split dollar, right? Because it costs me less on the corporate side to offer that to the employee who's perhaps in a higher bracket. If it's the other way around and I'm taking the deduction in the higher bracket and the employee is paying taxes in a lower bracket, then perhaps it's the other way. It's executive bonus. It really doesn't matter, does it? It really doesn't matter to me one way or the other as an insurance professional how they're paying for it. I want to identify the best way for them to pay for it. I want to identify options and how to pay for it. Gonzalo and his team can identify case design options in terms of how you're going to offer this benefit to this new employee to attract them to this new company, to make it robust in terms of more robust in terms of a program for them and a package for them, to recruit them, to retain them, to reward them, to make sure that they're growing with this startup just as the startup owner is, right? So I wanted to tell that story and use that information, that insight that we have come out from our white paper at Prudential just today to sort of put this all in context. Because I think all too often we're just skipping over the startup phase. We're thinking, oh, we're not a bank, or, perhaps as a financial advisor, I'm not a banker. They need credit. Well, yeah, they do. What do they need to protect against that? We talked about that life insurance. We talked about key person. I also think we need to start thinking about, even at the startup stage, those executive benefits with life insurance. So please think about that as you think about people who are in startups. So, look, I've got some of the standard types of disturbance points or points of disturbance on the left-hand side of the page. protection if the owner dies or disabled. We talked about that. Protection to pay back loans. We talked about that. And I've got some conversation starters here on the right side of the page. So when you're thinking about people that are in the startup phase, we've got not only what the needs are, we've got how you would start up conversations. I mean, a lot of you are very experienced. You don't need this from me, but they're there for you to think about, they're there for you to consider. Maybe there are some questions in there that you haven't been asking that you'd like to ask. And then also it shows you some applicable materials that you can link to through the ebook. So when you get the ebook, you can just click on that. It'll take you right to the materials, because one thing I didn't mention, and I should have mentioned, and probably all of you are talking about right now or thinking to yourself about on the other end of this camera, is, Brett, you didn't talk about buy sells in the startup phase. That's important too. Obviously it is. Yes, absolutely it is. And, I think it's always important to talk to an owner about, what is your ultimate plan for this business? Well, my plan is to grow. My plan is to grow. I want to grow, and I want to, really live my life's dream. And yes, but what's your goal for the business? Are you going to grow it to sell it? Are you growing it to have it for the rest of your life and pass it to your children? Do you have a partner that you're going to pass it to? What if you don't have a partner to pass it to? How would you sell it if something happened to you? Would you want to sell it if something happened to you? One of the questions would be, if they said, well, no, I just don't think about that. What about your wife if you're married? Or what about your spouse, your partner? What do they feel about this in terms of how you're going to really transition out of the business? Even at the startup phase, people need to be thinking about that. And oftentimes they need to think about, are they appropriately funded for such a buyout? Do they have a buyer, number one? And there are inside buyers and outside buyers. There are unilateral buy sells with firms down the street. Do they have somebody in mind? Is that somebody a willing buyer? Do they have an agreement on valuation? And do they have the appropriate valuation? And we'll talk more about that later. We have to start thinking about this in the startup phase. We can't just leave that to the mature phase. So growth, right? Growth has its own risks, right? And usually this is where I talk a lot about executive benefit planning, and I will talk a lot about it. We have this tax package, and we see that the corporate rate may go up to 25%, 28%. That will mean that the cost of deferred compensation, right, is going to go up. Because when I do non-qualified deferred compensation, I have a lost deduction, right? I don't get to take the deduction in a non-qualified plan on the corporate side. So if I'm in a higher tax bracket, my cost of deferred comp may go up, or would go up if we have a tax increase. Well, that's just something that I have to plan for, right, on the corporate side, because the key point here is that the corporation wants to do this planning to retain key employees. In deferred compensation, remember, it's an agreement between you and me. It's an agreement that I will, for example, in a SERP, in a supplemental executive retirement plan, I'm just going to pay you an additional $100,000 a year at age 55 to age 80, right? I have to fund for that somehow. Or if it's 65 to 80, I have to fund for that. Now I could fund out of current cash. I could put it in stocks, bonds, mutual funds. I could do many things. But what I probably would do is put money aside in a variable universal life insurance contract, an indexed universal life insurance contract that would have cash accumulation, be an asset on my company's books, and pre-fund for the obligation that I have to you to pay out that non-qualified deferred compensation benefit, right? The cost of that may go up, from a loss deduction standpoint, but think about this. The value of life insurance goes up, right? Because unlike stocks, bonds, and mutual funds, when they're held in the corporate name, life insurance provides tax deferral, right? Tax preferred withdrawals and loans, and then an income tax-free death benefit for cost recovery of part or all of the benefits that I've paid out, or a survivor benefit, for example, that I might pay out. So I know that I'm really talking about a lot of things here that you may have questions on. Think about it this way. Here's the key point. Growth means that I have to not only work harder myself to achieve the goals that I have, but also I have to recruit, retain, and reward the right talent. And we talked about that in the startup phase, even more important in the growth phase, right? So what's my risk? If we were going to put it into that risk, need, and opportunity type of construct that Gonzalo mentioned in his invitation for this session. If we think about the growth stage, the risk is that, yes, I may lose a key person to death. I need to insure them for that purpose, but I might lose them just to another firm, right? So how am I going to reward them? One of the ways is through non-qualified deferred compensation, right? I agree that I'm going to pay you a certain amount of money if you stay with me for a certain amount of time. High degree of control on my part, right? I'm going to keep you. Hopefully, I'm going to pay you enough money in terms of wages, give you a great benefit package, and then on top of that, as a key employee, a highly compensated employee, I'm going to give you more, and that creates that need for life insurance to really be the asset that equalizes that liability, or at least goes a long way towards equalizing against that liability. Protecting against the risk of that liability is probably the best way of saying it, and the most articulate way of saying it to any fellow attorney or CPA that is working on these types of cases. So when we think about protection in this phase, obviously key person, we still have business loans to protect against. We have the risk of a person leaving. I've talked about non-qualified deferred compensation. I've talked about, the increase in the cost of that to the employer, but also the increased need for life insurance to shelter money within the company from taxes as the cash grows. So life insurance, very important element of this conversation, will continue to be a key element there. Now, I talked about split dollar and executive bonus as well on the executive benefit side. So if you really think about it, on this end of the spectrum, this is the most control, right? This is non-qualified deferred compensation. This is where the company owns the policy and is the beneficiary of the policy. It has an unsecured promise to pay the executive an amount of money, and it's using the life insurance policy as an asset on its books to offset or partially offset the liabilities that it has to the executive going forward. Now, what if you're in a situation, like I said, with the startup, with the growth, that somebody says, you know what, I don't like that. I want control of the policy myself. That's very important to me. I mean, with COVID, I saw a lot of people die early. I want all the control to be me. You can do that. You can do it through collateral assignment split dollar, where I, as the executive, own the policy and collaterally assign back the premiums paid to the company. You could do it through executive bonus, depending upon what the tax situation is and how important that is to the customer. What you could do is you could bonus out the money so that the person owns the policy themselves, takes the money into compensation every year. The corporation is entitled to a corresponding deduction every year. So corporation pays, deducts on the corporate side, employee takes into income and pays tax on the individual side, puts the after-tax sum into the life insurance to grow as a life insurance retirement plan in an indexed universal life insurance contract and a cash accumulation type of life insurance contract. And usually it's designed for a minimum death benefit, maximizing the cash, right, to supplement that person's retirement income through the cash, or provide that death benefit to the insured's family. Now, here's another wrinkle from the paper this morning. Remember, the paper had 4 predictions. 1, greater emphasis on closing financial security gaps out of COVID. 2, borderless employers will transform how companies recruit, retain, reward employees. We've talked about this. And number 3 was all parties will rethink how caregiving is supported. Now, why is this important here in the growth stage in a business conversation, Brett? It's important because remember, I have an agreement. The employer wants the employee to stay. And if I have a non-qualified deferred compensation agreement, the employer's got all the control of the policy. Let's say the employee says, I really want control. I want that supplemental retirement income. I like that LERP idea. I like saving more for retirement. I like that you're going to do that for me. You're creating a great benefit package for me, and I'm going to help you grow. I'm going to help you achieve. I'm going to help you do your business goals and achieve your business goals. So I really like this, but also I'm a little concerned if something should happen to my parents or to anyone else, that I'm going to have additional monies or an additional source of money so that I can have flexibility in how caregiving is managed in my home. Perhaps it's cash value from the life insurance contract to help out a parent. But what if something happens to me, or what happens to my husband or my spouse? What's going to happen there in terms of how we're going to get money to take care of ourselves? I don't want to go into a nursing home. One of the key insights of this paper is fewer people will go into nursing homes. Fewer people will admit their parents to nursing homes. They've wanted for years. We know this statistically. People want at-home care. It's increasingly becoming the point under a emergence from the COVID crisis that people are continuing that trend. So where's the point here, Brett, on life insurance? Not only do you get the income tax-free death benefit for your family if something happens to you and you die prematurely, not only do you get the supplemental retirement income from the cash value if you design it the proper way, but you also get the ability to accelerate the death benefit should you become chronically ill, and you can use that benefit, use that cash, right, from the death benefit to help support yourself during a time of care. And obviously I'm talking about the insured, right, being the one who is, and the employee being the one who needs the care. But, you know,
hey, Brett, Brett,
yes.
I'm sorry, just a quick question, a little interruption here. Chronic illness or the bar rider at Prudential or certain long-term care riders on policies that are corporate owned, is that portion of the premium, or can that portion of the premium for that benefit be deductible?
No.
We see, okay, so only on true long-term care contracts can you deduct the expense. So not
That's
even
correct.
if it's broken out, right?
That's correct, Gonzalo. Great point, because we're talking about benefit planning, right? And you know, you have to really pay attention to what you're providing. You know, obviously, too, the contrary point to that would be, well, how is it taxed on the acceleration of the death benefit to the company? It's taxable, right? So remember, on corporate-owned policies, you don't get the deduction; it's taxable, right? So it's on the bar rider, on chronic illness riders. So, you know, you have a situation where you can probably design other benefit packages, you know, to achieve deductions and to achieve other tax results that you're thinking about. But it's also a great point to say, you know, one of my greatest friends in advanced planning one time said, you know what, sometimes, yeah, you do have taxes, or you don't have the greatest tax benefits that you're looking for, but you still have the money. You still have the source of money. You still have the liquidity. You still have the way of getting the money, right? So the tax implications are very, very important and should be definitely minded, right? But also, I wouldn't want somebody to say, well, no, I'm not going to add the bar rider because of these negative tax consequences, or you know, potentially, and right now, currently, negative tax consequences. What I would want them to say is, does it make sense, right? Even in light of the tax ramifications and even in light of the tax rules, to have the additional source of liquidity. And if it does, it does. And if it doesn't, it doesn't. Right?
Got it. I have a follow-up question, especially as you're focused on the growth stage. So companies that have, a little bit tighter cash flow than somebody that's more mature, right? So one of the really important things is to retain key employees. And there's a number of companies out there, I think Guardian or somebody else has something, then they're pitching these quote unquote stay bonus arrangements.
Oh yeah.
Can you talk about stay bonuses? Because it's an interesting kind of combination almost between a deferred comp arrangement and a bonus plan. So what does that look like?
I love it, love it, love it. Thank you, Gonzalo, for the stay bonus. Okay, the stay bonus is this. Gonzalo and I are in business, and what I say is that, look, Gonzalo, you are a great asset to this company, but I've got Jane over here, and she's doing a great job. And Jane, I've sensed from you, Gonzalo, that you may think that you don't have an upward mobility. You do. If something happens to Jane, you're taking over, right? And Gonzalo may think, well, that's great, Brett, but I'd like a little bit more now. But then something does happen to Jane. Okay, now I need money, right? I should have had a policy on Jane, right? Key person policy. And maybe it wasn't to pay off any debt. Maybe it wasn't to go out and hire somebody else. Maybe it's to keep Gonzalo, right? Maybe it's to keep Gonzalo, because I know that Gonzalo's been waiting in the wings for years and years and years, being patient. But now it's time where Gonzalo knows, hey, I can do that job today. And I've been waiting for a raise, and maybe Brett's been treating me well, and I like him. But now how about a little something for me to stay? Yes, absolutely. You're going to have to pay that. For the most qualified employee in this fact pattern is Gonzalo. And I want to keep him. I need the liquidity. How do you get that liquidity? You get that liquidity by having a policy on Jane, right? So that if something happens, and it wasn't to go out and hire somebody from the market, it was to make sure that Gonzalo stayed. That's the stay bonus.
Thank you. I've also seen, and again, maybe this is appropriate more to the mature or even the transition phase, but I've also seen it used in the context of a business owner looking to sell or wanting to sell the company, but putting themselves into kind of this 3 to 5 year plan of, I need my key people to stay until I sell this company. So it's really important to say, and then, the question I was going to ask as well is, how do you structure it? Is it split dollar? Is it a deferred comp arrangement? What does it look like in terms of, either the Jane and Gonzalo situation or stay for 5 years, help me keep the company going and growing until the eventual sale or the transition or whatever that transition planning is.
Yeah, I do think they're two different types of scenarios. For the I want you to stay 3 to 5 years, I think we're much more into split dollar or executive bonus. And there I would say that it really depends on control. Who wants control? How important is control? Who's really driving the conversation? Because if I've got the situation where, I want you to stay now, or you and Jane to stay for 5 years, Gonzalo, now I've got to go to you and say, look, I'm probably not in a non-qualified deferred compensation situation because I don't have a long enough time horizon, right? But I certainly have a situation where I could bonus you money. I could loan, if we're doing split dollar, I could loan you money. You could collaterally assign me the premiums. How sweet do I want to make the deal, right? And I think that it could be a combination. It could be a combination. It could start out as split dollar, and then we could crawl out that split dollar. We could bonus it out, or bonus money for the payback if we want to do it, in a two-step analysis.
Yep. Great.
We can do it a lot of different ways.
Thank you, Brett.
You bet. So let's move on. We're through the growth stage. Now we're to the mature stage, and we've talked about a lot of ideas that sort of drift between the growth and mature stage. Gonzalo and I just had a back and forth on the stay bonus. I think that that's a great idea. We also had a conversation about the two types of stay bonuses. I want you to stay, and then money to keep somebody if something happens to a key employee. And I think that one is definitely overlooked. So thanks for the opportunity to discuss that. But I think that one of the mature risks that we see, and it also goes into the transition phase, is no succession plan, no business valuation, right? We have a valuation tool at Prudential that very few people know about, where we can do just simple valuations. And to the extent you're interested in that, get in touch with Gonzalo and we'll work on the case. Because here's the deal about succession plans. Yes, I need a written buy sell. Yes, it establishes a market. Yes, all of that. But the key thing here is that people don't know what their business is worth. They don't know what their business is worth. And if they think they know what their business is worth, it's really not founded on anything other than their own opinion, right? And I'm obviously overgeneralizing. Some people have a really recent business valuation that's very useful, right? But if they don't have a recent business valuation, oftentimes what they're saying is, hey, I know my business, okay, just like you know your business, and I know what my business is worth, and I think I could sell for this. Whenever I hear the words, I think I can sell for this, it means to me, I need to ask the question, have you done a recent business valuation? Would you like to have a look at just a model of a business valuation? Not going to a CPA firm, not going to a valuation expert yet, but just we'll do a couple of models for you just to show you. If you got 3 years of tax returns, we can do that, right? It shows them where they are. And you have all kinds of tools available to you through Agency One to do this, and all kinds of companies that will help do this. We do it as well, okay? Because we know the importance of that question and the answer to that question. So we want to help you find that answer, because we want to know what exactly are we succeeding to, right? What exactly are we building the succession plan around? And then we ask the other questions. Do you have a buyer? Is it an inside buyer or an outside buyer? Do you want to sell during life or at death? These are very important questions. Very different types of results happen, and different types of planning happens. And when you think about the loss in terms of the step up, the potential loss of the step up, this is going to become one of the most critical conversations. It's already a critical conversation, but it's going to become one of the most critical conversations that one can have, is around who's going to buy when, for what amount, how are we going to deal with the gain situation to the extent gain is applicable? Because remember, the loss of the step up, the proposals out there have all kinds of carve outs. And we don't know where this is going to land yet. Is it going to be a carve out for small businesses? If somebody from the family is in the business, what does that mean? Do they have to run it? We don't know what all this means yet. We don't know what will be passed. But here's the deal. We don't need to know all of that just to go to the small business owner today and say, you know what, there's a lot of talk about the loss of the step up in basis. That would really impact business. Well, you bet it would impact business. But a larger conversation is just this. Do you have your succession plan updated? Do you have your valuation updated? A lot of business owners that I talk to don't have that. Or haven't done that in a while. Would you like to do that? Would you like to embark upon that? Would you like to take steps toward that? As we come out of COVID here, see where you're at, see what we can do to make your plan better. Right?
Yeah. Brett, it's interesting because a lot of operating agreements call for an appendix or an addendum where you're supposed to put the end of year valuation annually into the operating agreement, because if during that year you're buying out a partner, somebody dies, whatever, having that valuation in your operating agreement and attached, or at least some documentation that you've provided some sort of evaluation for the firm on an annual basis, is really important. And not enough business owners do that. It's
exactly right.
Yeah, I've seen a lot of them.
Yeah, and it's because they're concerned about their growth. I mean, look, they want to do their business. They want to, in the past couple of years, they just want to survive, maybe, right? So they may not have done it for that reason. I'm just trying to day to day just pay the payroll here, right? Now I have some time. Let's make sure this is done right. Let's make sure it's updated properly, to your point, as is called for in the agreement. In most cases, let's make sure that we're really dotting the I's and crossing the T's, and really thinking through, what would we do if we had a loss of the step up in basis? What would we do if we had taxable capital gains in excess of maybe $1 million exclusion, or maybe $100,000 exclusion during life, right? Because the Van Hollen proposal is $1 million at death, but 100,000 during life. What would we do? How would we handle that? Would we be doing an installment sale? How would we handle, making sure that there's enough money such that if I die in the midst of the installments, the person can basically accelerate the payments? That's a life insurance sale, right? How are we going to do all that? How are we going to take into account all of the different variables that could happen and build a flexible plan, a working plan, a living plan, a business plan, and a business succession plan that builds in the same kind of flexibility I want as if I were building an estate plan with flexibility? Because really, the business succession plan is the estate plan for the business and coordinates with the estate plan for the person, the individual. So we absolutely have to think through all of the different variables that could happen and help them with simple solutions to make their plans better today and set themselves up for success for tomorrow. So with the
hey Brett,
yes,
Brett. So let me just jump in here and ask a question. And it's you referenced it in terms of making sure that you go back and see that the plan is implemented, and what we're doing in terms of the business plan versus the estate plan. And earlier this year, Gonzalo and I were speaking with an advisor about his existing book of business. And he specifically said that he had been working with three distinct business owners whose businesses had exploded in value during the pandemic. Right. And, just sitting in his office, he knows that from a business perspective, they are not adequately insured. They're not adequately insured. So my question to you is, when you put these plans in place, let's set the expectation during that initial meeting that, this is not one and done, right? We don't put it in place and then I'm not gonna reach back out to you. What, in your opinion, is a reasonable, benchmark to say, you can expect to hear from me once a year, once every 2 years, that, we need to make sure that the work that we're doing, it's like, bell bottoms will come back into style, but, when everyone's wearing straight leg jeans, you don't want to be wearing your bell bottoms. You've got to update your wardrobe. You've got to update your business plan and your estate plan. Do you have bell bottoms in your closet, Brett? I'm like, but you know where I'm going with that.
There's a picture of me in a leisure suit somewhere.
There you go.
Believe it or not. But, I agree with that. I think it depends on the situation. And if you've got a business owner whose business is exploding, you're talking hundreds of millions of dollars or tens of millions of dollars. And I have seen these cases too, where they are back every 6 months, right? Touching base with the lawyer, with the group of advisors, right? As I know, Agency One works in those groups all the time with lawyers, with accountants, with everybody that's involved. It could be whomever it is, family offices, family office advisors, and saying, have we got this right? Right? Do we need to bump coverage? Do we need to move coverage to a different entity, a different trust? Do we have this right under the circumstances, and especially in a situation where we have such uncertainty in terms of the tax situation, right? I haven't even touched on the estate taxes. And a lot of people say, well, Brett, President Biden didn't say anything about estate taxes. I heard a really great speaker last week. This isn't my idea. This was this great speaker's idea from the Washington, D.C. area, by the way. Many of you may know this person. This person said, I think that's a head fake. It was Jeff Reschetti, who said, I think that's a head fake on a call for the industry. Is he right? I don't know. Bottom line is, anything could happen in this tax environment. We need to make sure we're going back to our clients and saying, okay, we're going to look out and we're going to do the best we can to prepare you for uncertainty. And we're going to do our best to prepare you under the current law today and protect you now. And then we want to come back, to make sure we have this right, to tweak it, not only for what could happen with taxes, but to your point, what could happen with your growth.
Yep.
With your growth. I think that that's absolutely right on. The mature, that we're all in conversation in the mature stage here, that relates to the mature and growth stage. So that's why this is on the screen. And the transition stage is, we've talked about it. There is no business exit strategy. It hasn't been updated. Unequal distribution with children. I haven't talked about estate equalization. Very important, especially in a case where we may have the loss of the step up in basis on business assets. And we have some children in the business, some children out of the business, adds a whole new wrinkle to what's going on. And then of course, in the transition stage, we're always thinking about and always having an eye towards the estate planning side of the situation, and maybe doing, a sale to an intentionally defective trust, or maybe doing a gift and note sale. Look, there are proposed changes to the grantor trust rules that may change that game forever. We need to think through how we're doing those plans now. I heard a really great speaker a couple of weeks ago talk about, I may not want to gift my capital assets now. I may not even want to sell them right now, depending upon what they do with this legislation. Maybe I want to take a loan and gift cash, and then if our 85-13 grantor trust rules stay the way they are, in other words, they don't change, then I can swap in business assets for the cash later on. Thought that was a really, really good idea. And I know Agency One, in terms of premium financing and understanding the credit markets and all of what you can do in the fourth trend here in my paper, ultra low interest rates environment will, we believe, persist, according to this paper. All kinds of opportunity, not only with the sales to the intentionally defective trust, but also the sort of variations on the theme. When you think about having to go out to the market and get a loan for the cash, so that you use cash instead of gifting a capital asset right now, if you're worried about the Van Hollen proposal being retroactive, right? I think that's where, really the expertise that Agency One brings to the table, that you and your own firm as a broker bring to the table, can bring to your client. The idea can bring to the advisor, the idea can bring to the attorney, the idea can bring to the accountant, the idea about how to do the deal, right? And not let the tax obstacle or the uncertainty of the tax freeze us. Right? We absolutely have to move our clients toward their goal, to achieve their goal, their business goal, their estate planning goal, and also secure the proper amount of coverage while they have insurability. So, I guess I'm going to end on that point, Gonzalo, and we have about 5 minutes left for questions. I've got a lot of other materials that are in this ebook that your listeners will have a chance to review at their leisure. But I think that a lot of the sort of the current events and the white paper sort of developments really take precedence over the materials. The materials are important, but it's the ideas, and it's also the motivation, and it's also the importance of action, I think, that takes paramount importance now in this very, very interesting time in which we live.
Well, I'd like to just, as we're wrapping up here, Brett, I mean, I was on a Biz Equity, is a company that does business valuation software, and we have the software and we participate in their community. Some of the statistics around the amount of businesses that are out there that are underserved, nobody's talking to them. The incidence of the fact that, they're in either coming out of pandemics and haven't done reviews and haven't valued the business and so on. But more importantly is how few of them actually have done anything about some of their succession planning. And we'll talk about things like updating their operating agreements, updating their buy-sell agreements, all those kinds of things that are just, they're being ignored. I mean, and for those of you that are on the call, I mean, this is a massive, massive opportunity to talk to business owners coming out of COVID and in the environment that we're in, to really begin to have some meaningful dialogue around all the things that they should be considering and looking at that are going to provide opportunities for you all to do some really good work for these business owners and maybe sell some insurance, which I think everybody here has some interest in.
And Gonzalo, to that point, and if you have any questions, we'll take them. But to that point, I think that's the key, right? I mean, look, we always lead on the estate planning side, or at least I always have, with how can I help you first solve your issues under the law, right? With other tools. And then let's see how life insurance can make it better. Same thing in business, right? To your point, how can I help you get your buy sell updated? How can I help you get your valuation perhaps updated, and put you in touch with the right people to do that? Let me do that first, because that's what the business owner really, fundamentally cares about. Do they have themselves set up for growth? Do they have themselves set up for the right transition? Do they have themselves set up appropriately for their goals, for their business goals and their personal goals? Life insurance can make this so much better, though, in so many ways, depending upon which idea that we're talking about. We can just connect it to the part or the stage that they're in, the problem that they're facing, the opportunity that they have, and connect life insurance's benefits with how to make their plan better after we help them clean up the non-insurance issues.
Kathy, wrap up comments, and Brett, any final thoughts?
Well, if there are no questions, I just really enjoyed being with you today. Thank you so much to Gonzalo, to Agency One, to Kathy for setting this up. My partner in the field, Tim Eads, who serves Gonzalo's firm. And we just really are so honored to be a part of Gonzalo's business as a business partner and Agency One's business as a business partner. It's just an honor to be here today. And as we can continue to be helpful to you, we look forward to doing that.
Terrific. Well, thank you, Brett, and thank you, Tim, and all of our friends at Prudential. Now, what's next? During the months of June, July, and August, Agency One is going to be holding these webinars once a month. Our next webinar is going to take place on Wednesday, June 16th at 3 o'clock Eastern Time. We're going to be discussing IRAs and qualified plan maximization and wealth transfer strategies, and a discussion of the Secure Act. Our featured speakers will be from the Advanced Markets Department at John Hancock Life Insurance Company, and also an Agency 100 advisor. Please mark your calendars again for Wednesday, June 16th at 3 o'clock, and we will be sending invitations out probably next week. I would like to wish everyone a terrific Memorial Day holiday. Agency One is closing early on Friday at 2 o'clock to allow our employees to take advantage of a long holiday weekend, and we will also be closed on Monday, May 31st. We will be back bright and early on Tuesday morning, June 1st. These are my closing announcements for today. If you have any questions or would like additional information, please reach out to me or Gonzalo or Dennis. Thank you for joining us. That concludes the webinar for today. Thank you.